You are listening to Keystone's Stock Talk Show, episode 243.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We are back this week with a busy show. I'm going to kick off the festivities with a snippet of a recent presentation I gave on a couple of structural mistakes we often see far too often in the portfolio building process. Aaron will answer a viewer question on profitable Canadian microcap Gatekeeper Systems Inc., symbol GSI on the TSX Venture, a video and data solutions provider for public transportation and smart cities. The company reported a very strong Q1 fiscal year 2024. Aaron looks to see if the growth momentum can continue. Brennan will circle back on Kevin O'Leary-backed Wonderfi Technologies Inc., symbol WNDR on the TSX, which dubs itself a leading provider of information for the digital asset industry. The stock, which is down 89% from its highs, has bounced lately on renewed crypto enthusiasm and promises to become cash flow positive in the near term. Is it enough to make this serial share issuer interesting, or should this dog be taken out behind the barn and shot? Brennan will let you know. Finally, Brett revisits 23andMe Holding Co., or symbol ME on the NASDAQ, a human genetics and biopharmaceutical company, which continues to see its share price lose ground. Is it finally a buy? Brett will give you his thoughts. All right, let's get to the show. We'll welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing?
Great.
Anything new? Well, we did just come out with a Canadian Dividend All-Star Report, our 2024 Dividend All-Star Report. I don't know what could be more topical than that today, unless you guys got anything else you want to talk about.
No, that's pretty much it. Yeah, so this is the report was just released on Friday, and this is a report we put out every year. It covers all of the dividend-producing companies in Canada. So we start off with about 400 dividend payers. We're researching every one of them. We funnel that down into essentially 18 current buy recommendations out of that 400. So the 18 that we think provide the best opportunities based on growth, sustainability of the dividend, attractiveness of the yield, and then the ability to grow that dividend over time. I mean, really the core of it is we want to find companies that are paying a dividend, but also growing the dividend. So yeah, as I said, it was just released on Friday. It takes about 2 months of solid research to put that together. So we're happy to get that out to investors. And there's quite a few new companies that we highlighted in there that we're interested in. And in fact, I just was just talking with the guys there that I've reached out to one of the management teams, and there could be another recommendation.
Yeah, one of the things that I love about when we do these larger reports, there's certainly a lot of work. They can take months to put together, but it's the research process that we're doing when Aaron's looking at every dividend stock in Canada, or we just put together a recent cash rich report where we go through 3,500 companies in Canada, screen for net cash positions, profitability, and then we look at the smaller cap end of the market. Well, that report takes 2.5 months to put together, but during that report, we identified 3 companies that we could add to coverage, and we don't just wait till that report comes out. We then issue a buy report on that individual company, and those 3 companies that we recommended this past fall have already done tremendously well. The first one that we recommended has doubled since September. The second one is up 67%, and the third one is up 35%. It's a good process to get to those companies. We don't wait till the report is released, but we release as we find those companies. And I know Aaron issued a report prior to the release of this of his Canadian Dividend All-Star report as well, a buy on a company. So as we're going through that process, that detailed process of going through, Aaron's looking every dividend stock in Canada. He's going to release when he finds a good company, and it's a good process to use.
Yeah, it gives us a lay of the land, and then like you were just kind of touting a few those three names again. One of those names was in like a monitor report. I wrote a monitor where, it looked interesting. We're following it. We ended up interviewing management. Again, we get the lay of the land. We follow these stories and the fundamentals of these companies, and eventually they could become a recommendation, as some do.
Yeah, and out of that report, there's probably 5 to 10 more that we may love the business. We love what's going on there. They're either too pricey at present, and if they come into a range, during the course of this year, we might issue a buy, or we're waiting on something, an inflection point in the business. But like Aaron said, he went through that research, and now he's looking at another company that's come into a range where he thinks, that could be a potential buy. We're talking to management once again, and perhaps we have a new buy coming out of that report over the next few weeks. So it's interesting. Now, if we've hit that topic, we did a poll last week, did we not?
We got a poll. We got a poll. Yeah.
Let us know what the poll was.
Yeah, we asked which of the following commodities are you the most bullish about, our lovely viewers. So oil and gas came in at the highest at 30%, followed by gold at 26%, then uranium at 24%, then lithium at 11%, and copper at 9%. So the most surprising thing to me about this poll is actually how low lithium has become. I think if we asked this last year, we probably would have seen lithium be the highest, because it was really, lithium was the craze with EVs really going early last year, 2020, 2022. And now it's just fallen off, and you've seen that actually come off, especially on the speculative stocks. They've really come down over the past year.
Yeah, I'm not surprised to see uranium and oil and gas near the top of that list.
I think I voted copper.
Surprised uranium wasn't higher. I mean, it's been such a hot commodity recently.
Yeah. Mm-hmm. I was surprised it didn't take the number one spot, because usually on those polls, it's whatever is doing well right now ranks near the highest. But, we may have done uranium 2 years ago and we wouldn't have seen it, nearly as high. And you see it significantly higher probably right now.
Now, I wonder too if there's a regional bias on those polls as well, right? So if
I was going to say,
area where, uranium is important or oil and gas is important, you're more likely to.
We have a ton of Western Canadian users and clients and listeners, right? And that, there's probably somewhat of a bias given the region that they're from, for sure. All right. I think, does that end it for this week? Again, keep your questions coming in for our Your Stock, Our Take segment. Oh, Brennan might have something. We don't need to hear from him. But keep those questions coming in, and we'll give away one of those mugs.
Brennan,
what do you got?
Let the man speak.
What do you got?
No, it's this is just topical today because the first mugshot of Sam Bankman-Fried came out today. And it's just, I saw this meme that Liquidity posted on Instagram, and I just thought it was kind of funny how it started right over here versus how it's going right now. So poor Sam.
We're not so poor. I think the only mugshot that really matters is this mugshot right here. That is the mugshot that we want.
Fair enough. But anyways, that's all I wanted to show. Enough of that.
Yeah. Again, we went over. Sorry.
That photo was actually pulled from the person who always interviewed Sam Bankman-Fried, got acquired from the other uncensored inmate there, was leaked to her, and that's how that got out. It wasn't a full-on mugshot, but it was more of a casual picture. Yeah.
Nice.
The casual mugshot.
So he's in jail right now, or he's out?
Yes, in jail awaiting the sentencing, I believe.
Okay.
So, he was convicted, but they don't have the sentence. I think that's a month or two out. It was sometime in the next couple of months when he's actually going to get sentenced.
Has anybody heard any projections on what?
Well, that was my prediction for our 2023 prediction
of the sentence.
I said they're going to throw the book at him. I think it's one of those fraud cases where they're going to want to actually make an example of it.
Mm-hmm.
I've said it before. I'm not a lawyer. So
You're not?
I know
But he
it's
plays
shocking.
one on a podcast.
I know it's shocking, and
All these years.
that's what I put on my resume. But
Yeah.
Ryan still hasn't figured that one out. But no, I'm expecting a long period.
Well, I mean, it doesn't sound like Sam Bankman-Fried's going to be going anywhere anytime soon.
But the real point of Brennan's post there,
he's already there.
The real point of Brennan's post is that he's no longer hanging out with Giselle, right? Is that the point?
Basically, that is the point.
Okay.
Yeah.
All right. Let's move on.
At the bottom.
So there are times when we tackle more nuanced or complex portfolio issues when we speak at events. Recently, I gave a speech where I really wanted to kiss, not you, Brennan, sorry. I wanted to keep it simple, stupid. Often I find that when speaking with average investors, analysts or pundits are often overcomplicated. They overcomplicate investing or the portfolio building process and present information that is just not useful to the average investor, even sophisticated investors at times. So I really wanted to look at the basic ideas behind the structure of an average Canadian stock portfolio and show two major mistakes we see every day. For me, it really starts right at conception and really involves just poor structure. Now, what I'm going to look at here essentially is investors often come to Keystone because they are dissatisfied with their returns and want a better option. I can break down the most dissatisfied groups of investors into two broad groups using two common strategies. Again, this is if you're trying to beat the market. Most Canadians either employ a strategy called what we call mass diversification, that is the traditional big bank model, or they go it alone. Let's focus on group one first and why the strategy is really not working. Number one, this is those who have poorly constructed traditional big bank stock portfolios. These portfolios are typically composed of 5 to 10 mutual funds or 5 to 20 mutual funds or ETFs, each owning 100 plus stocks, so they own the market. It's all in the name of that magical word, diversification. The problem is that while diversification is useful in its application in modern portfolio building, it has become executed terribly. It's a good idea, but poor execution. As opposed to this guy here, where it's just bad ideas and even worse execution. Ha ha ha. Well, he definitely cannot balance a budget, on a positive note. As he has shown us, he can definitely balance himself, and we're all so impressed by that. Now, with this example of horrid execution in mind, I refer to a chart on optimal diversification or optimal portfolio diversification, which displays that by owning 20 reasonably diverse stocks, you have already achieved optimal diversification. And yet, by using a big bank method, investors often own over 1,000 stocks. This is poor execution, and we see it on a daily basis. This is what we like to call, wait for it, boom, diversification. Again, I think that gets funnier the more I use it, doesn't it? Now back to our slide on traditional big bank mass diversification. With this strategy, all you achieve is a complex fee-heavy portfolio that mirrors the market but underperforms due to those high fees. So let's look at number two, the second portfolio that we often see in unsatisfied investors. This is when you choose to go it alone. By chasing returns, they often end up with too much risk. These portfolios often consist of concept stocks, pre-revenue stocks, or junior exploration stocks, particularly in Western Canada. These portfolios, if we can even call them at all, are poorly structured with either too little or far too many stocks and are subject to impulse or panic buying and selling. They often take undue risk in misguided attempts to find blue sky type investments. Most often, this strategy will end in disaster. Now, you don't have to take on undue risk to build a portfolio that has a fighting chance to create real wealth. If you want to build true wealth, we want you to chase cash flow, not concepts. And in the building, less is more. Concentrate on quality over quantity. What we advise you to do is take control of your portfolio. If you want to beat the market, you cannot just be the market. With a big bank portfolio where you're owning 500 to 1,000 plus stocks through a mutual fund or ETF portfolio. You can create your own simple equity portfolio. Use a strategy that we call and have coined focused diversification. You're building a 15 to 25 stock portfolio gradually over a 12 to 24 month period. What this does, it reduces risk to short-term market corrections, and it'll provide flexibility to add to new positions as new opportunities come available. We were talking earlier in the podcast, when we do a sweep of, say, 3,000 companies in the US, we'll probably pick out 20 names. We may recommend 3 of those, but we're monitoring those other 17 for potential entry points during the year. If they come in that range, they can become a buy. So you have some dry powder available to add those companies. The process. So if you wanted to use our service or you wanted to start constructing your own portfolio today, starting with 3 initial positions, that's just 3 to 5 initial buys, and adding 2 to 3 stocks per quarter as new research or information is released. You don't always have to buy a full position in the companies that you're adding to your portfolio. Let's just use some broad numbers to explain that. Say if you had $100,000 and you were going to buy 10 stocks, you take 100,000 divided by 10. A full position then would be 10,000 in each stock. You could buy a half position, that would be 5,000, and then add as you go over time. So those are ways to layer in to individual investments or stocks as you go. All right, I'm going to stop sharing my screen. Any comments on that, or should we just move on to Aaron Dunn's?
I just want to know, is that a real image of Trudeau balancing?
It is. It actually is.
On the table?
So,
did he actually
so what I will give him is that is fairly impressive. Let's be honest.
That is impressive. Yes. I mean, maybe
the most impressive thing he's done in office, right?
Or ever?
Ever, possibly. It's true. No, it is a real image, but he's balancing himself, not the budget. All right, Aaron, you're going to look at, let's just move on from that. You're going to look at what company? Oh, you're looking at Gatekeeper, right? Aaron
Gatekeeper system. So am I up? Are we doing this?
You're up, sure. You guys have no comments on planking or?
No.
Brennan's like, what's planking?
I can't do that either.
We're too young for that fad.
Oh no, I know what planking is. I was surprised you didn't know what Chell was today. That blew my mind. But
Aaron, what's
all right,
Chell?
Let's move on. Let's take a look here at Gatekeeper system. So this was an email that we received from a viewer, Dave. He just wanted our take on the company. So it's an interesting little microcap company here, profitable microcap. Symbol is GSI, trades on the TSX Venture Exchange. The stock price is 64 cents, about a $60 million market cap. So this is definitely a microcap. And what they do is they're a provider of intelligent video and data solutions designed for the transportation industry, specifically public transit and school buses. And they're essentially designed to monitor the buses as well as any type of incidents around the buses for information that can be used to maintain safety of the drivers, as well if there's any insurance claims, then they're able to use that information to essentially support their claims and save money. So this is a platform as a service business. It's done very well over the last year. The stock has big move up in the share price in 12 months. From about 20 cents up to about 66 cents. Now, if we look back a little bit further over the past 5 years, we can see quite a lot of volatility. So in early 2021, it had reached a price of about $1.30. So it's right now down by about half. But as I said, recently coming up. And then again, so what they do is they essentially, they offer their services primarily to school buses and public transit. They outfit these buses with cameras that they can use to essentially monitor anything around it. So just as an example, you all know a school bus, when it stops, there'll be that little stop sign that pops out on the side. You're not supposed to go around the school bus because kids will be crossing the street in front of it. Well, what Gatekeeper system does is it can actually monitor if any vehicles violate that rule, drive past that stop sign, and it can capture that. It can capture the license plate and then send that information to the authorities so that person would automatically get a ticket. So that's just one example of what their technology does. Another example is they can also outfit the inside of the school bus with cameras so that they can monitor what's going on in there. Privacy is a focus as well, so faces are blurred, but they can essentially just make sure that monitor for any type of vandalism, bullying, essentially keeping the kids safe. Outside of school buses, they also do public transit as well. So one of their big clients is the Southeastern Pennsylvania Transit Authority. They've done had several contracts with them. Right now, they're saying recurring revenues of about 2.4 million per year from this particular client. But what they do is they have cameras on the bus, and if there's any types of incidences around the bus that result in insurance claims, then they have a record of what happened, and that can be used. So, interesting company. Let's take a look at the recent financial results, which were released in January. These were the Q1 fiscal 2023 results. So big increase in revenue, doubling to 9.8 million, up from 4.88 million, and also a big increase in the gross profit margin. So 49% gross profit margin compared to 32% in the first quarter of last year. They had positive operating income, 2.1 million, positive earnings per share of 2 cents. And this is compared to a loss of 618,000 last year, or basically zero earnings. So big quarter. And this is probably driving a lot of the share price return, although the quarter was just released about a month ago. But, certainly it seems like strong financial momentum. Looking at the commentary, the company says this is the strongest first quarter in its history by a large margin. They generated growth in both the school and the public transit segments. They now have an installed base of about 50,000 mobile data collectors, and they're actively preparing and selling recurring revenue services to help customers, again, monitor and optimize this video data being recorded every day. Their new offerings utilize AI, video analytics, software solutions, hosted software solutions, and wireless data connectivity. So certainly this seems like it plays into a lot of current themes right now with AI, which is very interesting. But when we look at a big quarter like this, we really want to dig in and figure out, what's going on here. Is this level of growth sustainable going forward? What's driving it? So when we see a small company like Gatekeeper double their revenues in a quarter, year over year, we need to figure out what is actually happening there. Now, in the case of Gatekeeper Systems, the company did sign a big contract in September of 2023. It was a $9 million transit video and data contract. And they announced on January 4th that they completed this contract. And the way that this works is that the $9 million is essentially being recognized primarily in 2 quarters, which is the first quarter of this year, the one that was just reported, and also the second quarter. So they are recognizing approximately 3.5 million Canadian in the first quarter of this year. So that goes into the revenue growth that they reported, with revenue being up about 100%. They're going to then recognize another 5 million in the second quarter, and then they're going to recognize 400 or 500,000 in the third quarter. And then after that, all of the revenue from this contract will be completed. So if we look at the first quarter that they just reported, doubling earnings, so earnings of about 9.8 million compared to 4.9 million last year, we're looking at about $5 million worth of revenue growth there. Well, 3.5 million of that is from this contract. So major boost from this contract. Now, can we consider this recurring? Well, it's definitely not recurring. This is a contract that ends, and it has ended. Now, they can certainly sign new contracts that will generate more growth. But as of right now, in terms of what we know, the majority of this growth, about 2/3 of the growth, a little more than 2/3 of the growth that they generated in the first quarter, was just basically based on this contract, and it's not necessarily going to repeat. Now, it's great that they're signing these contracts. Another thing is that about 1.5 million or so of that growth was actually from outside of this contract. So there could be some organic growth there, something that's a little bit more sustainable, a little bit more recurring. But one way to look at this is certainly that when we get around to the first quarter of next year, this may be a quarter that is hard for them to beat, and they may see a decline in gross profit margin and revenue year over year, or at least less impressive results. So being that it's a contract focused business, this is something that we have to consider. But we do think that fundamentally, financially, the company has been very successful. They decided to expand into the public transit market in 2018. They've signed about $40 million of contracts since then. I had mentioned that one of their big clients is the Pennsylvania Transit Authority. It looks like they've signed several contracts and extensions with them. That's a great sign if your customers are coming back to you and wanting to do repeat business. Looking at the balance sheet, good solid balance sheet. I mean, there's a little bit of cash, about $2.4 million in cash. No debt. There is about 1.2 million in leases that we'll just basically consider debt. But that's about a net cash balance, a small, but still a net cash balance of about 1.2 million. Good solid debt to equity ratio as well. So no concerns about the balance sheet whatsoever. And then finally, looking at the historic financial performance, a little bit of volatility, certainly. But, generally pretty good, fairly consistent growth in revenue over the last 7 years or so. We saw a big uptick in 2020, both in terms of revenue and in terms of earnings, and then a decline in 2021. That may have been due to some issues with the pandemic. It may also have been due to a big one-time contract being executed on in that year. But good revenue growth since then. Decent growth in earnings per share, albeit fairly low earnings. So they did last year about 3 cents in earnings. You'd maybe put them at about say 5 cents trailing 12 months, including that contract. So, about 12 times, roughly about 12 times earnings right now. Not a bad valuation. But again, a company like this can be lumpy unless they can add on more recurring revenue over time. So what's our take on the business? Well, I think it's really interesting. I think that it's worth a deeper look. And that's really what this type of analysis is. It's not necessarily to draw a conclusion on the company. It's to determine, is this even worth a deep dive? And I would say that this is worth a deeper dive. It's worth a talk to management, see what types of contracts are in the pipeline going forward, and if they're able to replace some of that business that they completed in the first 2 quarters of this year. So good fundamentals overall. Higher risk, microcap company, but worth a deeper dive.
Yeah, I think Gatekeeper has done quite well. It's you point out the major risk, the contract nature of the business. If you look back just to the August 2022 quarter, 9.8 million. Then you go November 2022, it's 4.9. Then February 2023, 9.7. May 2023 is 5.9. And then you go August 2023 is 7.3, and then November, the last quarter, 2023 is 9.8 million. So you can see it jumping around. Then it looks to be jumping around in the right direction, and it has been operating income positive for the last 4 quarters. So these are trending in the right direction, but it is the risk there when you're holding the stock. If you do have one quarter where they're just you drop down significantly over the past quarter, the market can take that as a negative sign, maybe overreact. I think if you're buying this company and owning it, you look at the balance sheet, and you also look at it on an annual basis, not a quarter to quarter basis. That's the way you have to look at it. Typically, a stock like that then gets a lower multiple. They don't usually get a premium multiple in the market, but it can change over time if they build up that order book and you see them continue to fill it. Then it can start to get a more premium multiple potentially.
One thing
if they can obviously add that recurring nature. Sorry.
Public safety perspective is I'm sure that what a lot of those systems are monitoring is also just the driver of the bus, right? So if you have kids, I mean, my kids don't take the school bus, but if you did have kids that took the school bus, you'd want to make sure that there's a safe person behind the wheel. And I'm sure that these systems are also monitoring how that driver is.
It does check off some of those boxes that could give it some sex appeal, right? Like with the AI, with the monitoring, all of those things. And as recurring revenue becomes a larger part of the business, as I understand now, it's just a small part of the business, but as it becomes larger, then you could start to get a premium multiple at some point. So if you could have it get a premium multiple and continue to grow earnings over time, that's a powerful combination. That's where you can get a real long-term winner. But we'll continue to monitor it and probably talk to management in the near future.
Yeah, just on the safety, I think that that's such a good point, because like I remember vividly like being terrified of one bus driver in high school or in elementary school. Sorry, we went on a field trip, and this bus driver ended up like we were going to church because I was at a Catholic school, and he ended up like running over this pole at the church, and he just drove off. He just kept driving. It's like he didn't even, no one saw it. He just kept driving, and you know. All these.
This was
he's
high
like
school?
Otto.
Sorry,
from
this
The
was
Simpsons,
this was
right?
elementary school. This was elementary school, so I was
school.
probably like, well, I don't even know how old I was. It feels so long ago.
Oh God. It was like 3 weeks.
I don't even know
ago.
how old
All
I
right.
am right now. Anyways,
Cool. All right. Well, isn't it your segment, young man?
yes, it can be. Just 1 second.
What are you doing? What do you got for us this week? Wonderfi, I believe.
Wonderfi. So yeah, I
Kevin
thought that
O'Leary.
I would do it. It's up on. Well, I mean, I'll just get into it here because. So yeah, I thought that we'd do kind of an investor spotlight follow up. So Wonderfi Technologies, WNDR on the TSX, currently trading at a price of about 25 cents and a market cap of around $160 million. So they're an operator of regulated Canadian crypto trading platform and other digital asset businesses, including BitBuy, Coinberry, CoinSquare, CoinSmart, Tetra, and then also SmartPay, which I believe is just for payment processing. So considering Kevin's quote of, if it's not making money after 36 months, you have to take it behind the barn and shoot it. It was put on your journey to teach you what not to do. And considering we're now 36 months into Wonderfi's launch in January of 2021, I thought that we would take a look at the financials to see if Kevin should in fact take it behind the barn and shoot it. So the most recent audited financial results were for Q3 of 2023, ended September 30th of 2023. But in January, they also provided a Q4 update to the market in regard to their Q4 2023 results, ended for December 31st of 2023. So I will look at that in a second here, but let's just look at the last balance sheet that we can see. So this is again from Q3 of 2023. The company's balance sheet really doesn't look bad. You know, they've got a net cash position with about 25.1 million in cash and essentially no debt. And looking at the income statement here, revenue is up year over year to 9.9 million from just 3.3 million last year. But the business still lost 6.9 million in operating losses for the quarter. And on the bottom line, net loss for the quarter was 10.6 million or 2 cents per share. And look at that there. You can see it down in the right bottom. Yeah, you guys see it. The company has increased its share count from 192 million last year to 622 million shares today. It's actually a little over that here. So here, just to show the increase in shares, they're now up to about 650 million. And essentially, the company's last raise was for about $5 million at a price of 22 cents per share, where they issued about 23 million shares. But the huge spike that you see there in July of 2023 was for 271 million shares issued to CoinSquare's shareholders for the closing of the Wonderfi, CoinSquare, and CoinSmart business combination. And this is partially why we're seeing this revenue growth as well. Now, looking at the company's Q4 operational update, more just at the bottom here at the guidance, the company is guiding toward 29% sequential growth over Q3 at the midpoint. And for non-adjusted EBITDA and operating earnings, they are anticipating it to be positive in the quarter. So does this mean that the company has now achieved consistent profitability? Definitely not. But sure, it's great to see them guide toward operating profit. Again, this is operating profit, not net profit. But I think the business still has a long way to go before it can prove that it will no longer have to dilute going forward. And last but not least, well, Kevin, your 36 months are up, and consistent bottom line profitability and cash flow have yet to be being achieved. And, I think that it might be about time that you take up your own advice and take it behind the barn and shoot it. And I mean, I only kid. Like, who knows, what will happen here. We have seen the stock, increase recently. I just don't see a clear path toward the company, reaching real profitability yet. And again, we're up past that 36-month quote that Kevin O'Leary himself has said. So, it's a dog, in my opinion, and remains a dog.
Yeah, I mean, financially, it looks like a steaming pile right now, to be honest. And maybe they achieve operational profitability. I'm not sure how they're even defining that, to be honest, but maybe they achieve that.
Exactly.
But what if it's 100,000 and they have 600 plus million shares outstanding?
Exactly.
They need real meaningful profitability to make this company even worth looking at again. And it's going to trade, in my opinion, off of the sentiment around crypto right now. I mean, that's what it's going to do. And maybe if they can achieve some level of profitability, but the way that they've issued shares, like, they're a kid in a candy store, it's hard for them, given their revenue base at this point. It looks like it'd be hard for them to achieve meaningful profitability. Maybe the new acquisition will add significantly to revenue base, but it's likely going to have a high degree of fluctuation on a quarterly basis, as much of the crypto space has had. So we'll continue to monitor it, but there's a lot of dilution there.
Yeah. You can really see, if you look at it like any other crypto company, that October, November time period, after that, effectively all of them went up to 3x. Mm-hmm. So it's not really trading on the company fundamentals. It's just a macro backdrop behind it.
Exactly.
As well, just on the company's operations, CoinSquare is a crypto exchange, effectively. It has some other stuff in it, but it doesn't really have that same moat as other exchanges, as crypto is obviously very limited regulation. But you're seeing more regulations come in. So really the only catalyst I could see is if they get through that regulation, the Canadian government regulates crypto exchanges hard and they create a moat, but that's outside really management's control. And plus they would need to be the one who does get through that regulation gate, which may not be the case. You've seen recently in the US, Binance got hit hard after them, I think it was like $5 billion fine to the CEO there and effectively removed from the US. So it's not like they might not even be in the clear. You don't know what they're doing behind the closed doors. You only see their public-facing financials, which is a big issue with these crypto companies. There's a bunch of them, and especially the exchange space, when it's not regulated or hasn't been regulated historically, it can bring up a lot of risk once regulations are coming in, and then you need to be the one that gets through the regulations to have any sort of moat.
Yeah. Well, didn't we do a segment where Kevin O'Leary said that he would continue to invest in Sam Bankman-Fried even if he was convicted? And
I think I ended up doing like an investor spotlight on
chance,
him.
Right?
Yeah, I guess so. You might as well buy low, sell high.
All right, let's shift. Let's move on. Brett, you're going to close out the show, and you've got you're looking at 23andMe, correct?
Yeah, saving the best for last.
It certainly is sort of that, right? 23andMe. You've looked at them before on the show.
We've looked at them before, and that's really why I'm looking at them again, is because we've had quite a few comments publicly on our YouTube channel, as well as some from clients and just discussion in person as well. 23andMe, we last covered in May of 2023, and we got a few comments. So I really just wanted to go through how we progressed and really see where the company stands and whether or not I'm taking a victory lap or I'm going to be raked over the coals. So if you don't know, 23andMe, symbol ME or me on the NASDAQ currently trades at about 72 cents a share with a market cap of $348 million. They were founded in 2006. 23andMe is a consumer genetics and research company. The company has built the world's largest crowdsourced platform for genetic research. The company became public through a SPAC in 2021, and is like most SPACs at the time, it has fallen 92% since. And since we last covered it in May of 2023, it's fallen about 65%. So I'm going to say that's a victory lap for me, at least so far. But a quick look at the most recent financials, so fiscal Q3 2024, which is just the calendar year end of 2023. Revenues came in at $44.7 million, down 33% from the prior year. And for the trailing 9 months, down 25% at $155.6 million. This is partially due to their GSK contract being lowered amount from $50 million to now $20 million, and some of the contract terms change, and I'll get into that in a few slides. But loss from operations was $281 million compared to a loss of operations of $97.1 million. This is primarily due to goodwill impairment of $199 million in the quarter. The impairment relates to a previous acquisition of Lemonade Health, a telehealth platform, which it acquired for $400 million in late 2021. And that's roughly, I think, about a third of the value of their goodwill. I didn't fully break it down, but their goodwill value on their balance sheet is only about $140 million at this time. So they've taken a significant write down on that acquisition. But moving down the income statement, unsurprisingly, net loss of $278 million. Like I said, primarily goodwill impairment, but it was a loss of 58% per share compared to a loss of $94 million in the prior year and a loss of 20 cents as well. But removing the impact of that goodwill, we had a slight improvement, but it was still a loss of $79 million. And in reality, goodwill, the reason why it's not the weirdest thing to remove is this should be recognized over time, more so than just a single quarter, because it's trying to reflect the fair value in their investments. So over time, you see the investment move, but since it's a private company, they effectively just put their inputs in and spit out a price, and they do that every year or so, which is why you're seeing it at the calendar year end. However, even if we look at the almost always more favorable adjusted EBITDA, which removes the impact of goodwill and removes the impact of stock compensation, the company had a negative adjusted EBITDA value of $47.7 million compared to a loss or deficit of $43.2 million the prior year. So by this metric, which normally actually inflates earnings a bit, makes the company look a bit better. Remember, they're the ones deciding these adjustments. It actually shows the decrease year over year as the company in this metric has declined, as the share comp was not as large over the prior year. And that's really why adjusted EBITDA, you need to look into what they're actually putting into it. And you can't just take the headline figure, because a lot of times they will report it. Sometimes they'll have the financial breakdown like I have here in the press releases, but a lot of them don't. But I digress, because I just don't like adjusted EBITDA. So a pro for the company, though, it still has a strong balance sheet, which I covered last time, which is why you haven't seen this. Getting ahead of myself. Over the last same period since last year, we've seen shares increase about 6% to 480.8 million from 453.4 million. Not the largest increase, especially given the weaker financial state. However, the company does have a significant out-of-money stock options, restricted share units, as well as potential future issuance for stock plans. If you are hoping for that lottery ticket style gains like you do in these turnarounds, these stock compensation metrics can really dampen your return. And now we're getting onto the balance sheet proper timing. A pro for the company is the balance sheet. So you're not seeing that cascading dilution because they have this strong backdrop in their balance sheet. So when you're seeing other companies with financial weakness quarter after quarter, year after year, the balance sheet is what can support it. And 23andMe does thankfully have it for shareholders. But that cash position is dropping over time. They currently have $242 million in cash with no financial debt, but netting out the leases results in a net cash position of $164 million, about 47% of the market cap. Obviously, you need to price it down into the market cap and the valuations once you get to that high amount. That being said, the company's cash flow is negative, with net cash used in operations, I should say, of $138.5 million over the past 9 months, if you just do a linear extension of the negative cash flow, you're looking at about under a year or so from the end of, about the end of 2024 before they dip into a net debt and lease position. And then about 1.3 years, so about April 2025, before they burn through all their cash at the current rate. Obviously, things can change. With this, they can issue shares, they can reduce expenses, which they're already doing. They're reducing their workforce, as well as they can issue debt. But many times, once you see that debt that get issued, normally it'll be like convertible debt or something like that at a high interest rate. That's really the death knell for the company if you do see that. I'm not saying that's going to happen with 23andMe, but that is always a concern, is once you see that debt issuance, because it just spirals out of control. So why would someone want to buy 23andMe? I've seen many comments say it's a buy. A very recent comment, not picking on them, it just really emphasizes and highlights what bulls are looking at. It's a buy. They say, I'm not saying this, I should be clear. It's a buy at the current price. The upside greatly outweighs the risk. There won't be a competitor database half as deep as 23andMe for a decade with AI advancements and their massive database. Throw the financial results out the window, buy and hold. I disagree, but we'll go into the bull case. So the bull case for the stock really is they have this trove of genetic data, which pharmaceutical companies should be clamoring over. They should be really wanting to pay that premium since it's such a great database. But the reality just doesn't show that at this time. The company does have an unexclusive now, previously exclusive contract to license its data to GSK, a mega cap, Britain-based multinational pharma company, and they receive about $20 million, or they do receive $20 million per year as of their last contract up front, which is always nice. GSK in return gets genetic and phenotypic data, which 23andMe collects in the agreement. And they've had this agreement for now 6 years. Before, this agreement was exclusive, but now it's unexclusive. So that premium has dropped from $50 million a year as their last extension contract now to only $20 million. So if you do believe this data is just so valuable that every pharmaceutical company is going after it, why are we not seeing new licensing agreements outside of GSK? Now that it's unexclusive, they should be able to sell that point, but it's been since July, so about 8 months. And we've not seen an additional announcement. So where is this value from this genetic data, which is meant to be happening? Additionally, as well, the company does have some various phase 1 and 2A, which is just enrollment for 2A, treatments in development, which may provide some sort of value in the future, but that's still multiple years down the line. Phase 1 and phase 2 is not very progressed, or 2A, I should say specifically, where you need to either hit the market or sell it at a price where you have something substantial, which phase 1 is still very early on, doesn't have much value once you're only at that point. You need to get to that phase 3 at least before you're really seeing any sort of value developed in the market. And at this time, they probably don't have the funds even to take to market, so they'd be taking a haircut to sell it early on. But to wrap this up, I'll highlight a couple points. Referring to the previous comment, you can't just outright ignore financials regardless of if you're just a growth-oriented investment and looking at the future, 5-10 years in the future. You need to look at the risk reward of the company. Like the person says, they think it outweighs. But the real reason why you need to look at the financials in the case of 23andMe or any really other pharmaceutical development company is the risk is in the financials. That's what you're looking at here, is the risk. They have a declining cash balance as well as over the past year declining revenue, which puts a timeline on the company before it needs to raise capital in some form. Remember, you're an equity investor. You don't own the actual product, you own the shares in the company. So even if the product down the line does well, if your share is so diluted after multiple raises, which you will see in biopharma, it is meaningless if you bought in now, but it's been diluted a tenfold once the product actually has any sort of success, if it has that success in the first place. The other option you may be hoping for is some sort of a buyout, but the same issue occurs. It might be a year down the line or 2 years down the line from when you bought, and that cash flow burn has hit it so hard. Even since I last did the segment, not even a year ago, it has fallen over 60%. You think a company is going to pay a nearly 3x premium for a company if you bought it this time last year? And if it continues going at that rate, you're going to have to see more and more of a premium to get to your average cost before you see any profit. You're just trying to completely guess when a buyout is going to happen, which is just not a way to invest. So overall, the risk still outweighs the reward. And I really want to see if there's any potential in the company, I would want to see those additional licensing agreements, because that's where the value that people think is coming from. But for now, I just will not put 23andMe in my portfolio.
Excellent job.
Yeah, and the same
like, and isn't there
one thing I would wonder?
Go on.
I was going to say, one thing I would wonder is so when it comes to their database, do they have unlimited? I mean, if I were to use 23andMe's service, provide them with my genetic data, do they have unlimited use of it, or are there restrictions on that? Like, can I opt out? Can I say you can't use it for certain
I advise
purposes?
they burn that data right away and get rid of that
I'll
genetic data.
there's actually a couple points I can go through here. Is
Nobody wants it.
I believe in their terms and conditions currently, unless there's some regulations, because they do say people who have enrolled in the license to have their data licensed out. That is, so there's something in the terms of agreement. I didn't look too deep in that, but there is some sort of enrollment. Whether you can opt out, I don't know. That would be a concern. And as well, recently there was a hack, which was kind of their fault, kind of not. Is a bunch of passwords got exposed, not their fault, but this happens all the time with databases. But the issue with 23andMe is, since you're all connected, you can use puzzle piece A and C to figure out B.
Yeah. And
that's what happened here. They effectively use the strength of the connection to the platform to expose people's passwords who weren't exposed, or accounts weren't exposed, to the data risk. And that is something which obviously is a concern. There's lawsuits about it as well. And that is obviously a concern and as well, you could see that regulations change as well with something like that.
Yeah, certainly. I mean, especially out in Europe as well, right? But, in North America as well, there's a big focus on data privacy. And, it might not be a case where, it may have been a case where when they started collecting this data, that they had greater latitude in terms of what they could do with it. But since then, there's been regulations that have, restricted. I don't know specifically with respect to them, but I know that particularly in Europe, there's a big focus on data privacy, and there's been a growing focus on it in North America as well. So just something to consider. Yeah, but at the end of the day, I mean, they have had 8 months to sign new agreements to generate cash flow from that database. It still hasn't happened, so that would be a concern. Once they run out of money, they're going to have to start taking more drastic actions to stay afloat, right?
Yeah. I don't know if you guys saw, like, this is or go on, Ryan. You can say first, because mine's a bit of a tangent.
No, you go
on it. It's kind of an interesting. Okay, so a few years back, I think it was back in 2018 or 2020, there was a site. They don't list exactly if it was Ancestry.ca or 23andMe. They say that it was a different site, but they ended up using the database and basically linking, like they put in this DNA from this one murderer. Again, back in, he was murdering back in like the 1980s. They ended up linking him, or this DNA, to one of his siblings, and ended up catching him like that way by figuring out that it was, a link to a sibling. Anyways, it's kind of a tangent, but just interesting how, who knows what website this was that, is, allowing their data to be, used like this. And I mean, it's good that we're getting a murderer off the street. Don't get me wrong. But it's just, it's an interesting use of data that, they're also tracking down criminals that way as well.
What I was going to say is as an equity investor, like as far as the value of the database, the data they're collecting, I mean, the same argument could have been made when they're $10, $9, $8, $7, $6, $5, $4, $3, $2, and now they're below $1. You could have had that same argument then. You're left holding the bag as an equity investor if that's your only reason for owning the stock. Perhaps that database gets bought. It has a value at some point, but we have seen these where literally the equity has got to zero and the database is bought out of receivership. So, I mean, that can happen in these cases. And I'm not saying that's going to happen here today. I mean, there is significant sales still, but, trying to pick your entry point based on the value of a database, we'd rather have a valuable database and cash flow, and then maybe it would be something that would be attracted to us. And the database or the buyout would be a bonus, you got to value the company based on that cash flow. Otherwise, it's just pure speculation, and it's not something that we would consider investment worthy. I think that's going to end off our show.
Is going down.
Likely, yeah. And there's no underlying fundamentals there. You don't have a base to say, okay, it's worth this. Yeah. So that's going to end off our show this week. Keep your questions coming in. Next week, let's give away one of these mugs. Let's mug someone next week.
Perfect.
Keep your questions coming in. We'll pick the best one over the past month next week. So you got 1 week to get those in. If you're viewing this right now on YouTube, smash that subscribe button. If you're listening to this on iTunes, rate and review us. And as always positive reviews. I'd like to wish everybody out there profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.